40 to 55 years old. How to build a global portfolio. Top 7 diversification hacks. Did you know that during the 2008 financial crisis, investors with diversified global portfolios experienced far less severe impacts than those heavily concentrated in single sectors? 5. That's right. While some people watched their life savings disappear, others weathered the storm with manageable losses. As you navigate your 40s and 50s, your peak earning years, protecting and growing your wealth becomes crucial. Building a globally diversified portfolio isn't just smart, it's essential in today's interconnected world. Global diversification spreads your investments across different geographic regions, reducing your reliance on any single economy or market. Today, I'm going to share 7 powerful strategies to build a globally diversified portfolio that can help secure your financial future, regardless of market volatility. Understand your risk tolerance. Before diving into global markets, assess your personal risk tolerance. Consider your investment time horizon. How many years until retirement? A 45-year-old with 20-plus years until retirement might comfortably allocate 70 to 80% to equities, while someone approaching 55 might prefer a more conservative 50 to 60% equity allocation. Consider your comfort level with market fluctuations, current financial situation, and future capital needs. Strategic asset allocation, a long-term approach based on your goals and risk tolerance, keeps you disciplined regardless of market ups and downs. Master geographic diversification. While the U.S. market represents roughly 60% of global market capitalization, don't overlook international opportunities. Research shows that different regions often experience varying economic cycles. When one region faces a downturn, others may be growing, helping to smooth overall portfolio performance. Consider allocating your equity portion across U.S. equities, developed international markets, Europe, Japan, Australia, and emerging markets, countries like Brazil, India, and China. Global diversification opens up access to markets and sectors that may not be available in your home country. Diversify across asset classes. The foundation of any successful global portfolio begins with proper asset allocation. A traditional starting point is the 60-40 portfolio, 60% stocks, 40% bonds. Though this should be adjusted based on your personal risk profile. Consider these broad asset classes: global equities, global fixed income, real assets, real estate, commodities, and potentially alternative investments. Each asset class responds differently to economic conditions, providing balance to your portfolio. Implement sector diversification. Beyond geographic diversification, spread investments across different economic sectors. Avoid the common mistake of overconcentration in a single sector like technology or energy, which increases vulnerability to sector-specific downturns. Key sectors to consider include technology, healthcare, consumer goods, financials, industrials, utilities, and energy. Core satellite asset allocation combines stable, long-term investments as the core of your portfolio with more minor, targeted investments in specific sectors as the satellites. Consider currency diversification. A globally diversified portfolio offers protection against currency fluctuations. Investments spread across different currencies can hedge against the depreciation of any single currency. If the U.S. dollar weakens, holdings in euros, sterling, or other foreign currencies may increase in value, balancing out losses. When investing in international bonds, choose between currency-hedged funds, which minimize currency fluctuations, or unhedged exposure, which provides additional diversification against dollar weakness. Use smart implementation methods. Once you've determined your ideal asset allocation, consider different approaches to implement your global portfolio. Exchange-traded funds, ETFs, and index funds offer low-cost, tax-efficient exposure to global markets. They're particularly useful for core portfolio holdings. While passive strategies form an excellent foundation, active management can add value in less efficient markets like emerging economies. Establish a regular rebalancing schedule to maintain your target allocation, forcing you to buy low and sell high. Avoid common diversification mistakes. Be aware of frequent pitfalls when building your global portfolio. Home country bias is common. Many investors allocate too heavily to their domestic market out of familiarity. Over-diversification can lead to diversification. diluting returns without meaningfully reducing risk. Focus on quality over quantity, ensuring each investment serves a specific purpose. Don't neglect costs and taxes. International investing can involve higher fees and tax complications. Be mindful of expense ratios, foreign withholding taxes, and currency conversion costs. If you're ready to secure your financial future through global diversification, start by analyzing your current portfolio for concentration risks and gaps. Then, gradually implement your global strategy over 6 to 12 months. Don't forget to subscribe to Silver Peak Life for more strategies tailored to Americans in their 40s and 50s. Our next video will dive deeper into emerging market opportunities you shouldn't miss. Hit that like button and share with a friend who needs to diversify their investments. Remember, in today's volatile markets, a globally diversified portfolio isn't just an option, it's essential for protecting the wealth you've worked so hard to build.